Hi, and welcome to this week's market presentation. Latest news. As the ceasefire between Iran, Israel, and the US continues to hold, peace talks and nuclear talks between the US and Iran are set to resume this week in Oslo, in what would be the first direct talks since the recent US airstrikes against Iran. The ongoing diplomatic efforts continue to be mediated by Oman and Qatar, which are conveying the message that Iran is more open to a peace deal than in recent weeks. On the other hand, the nuclear cooperation between Iran and the IAEA appears to be on the downside following the suspension of direct IAEA supervision and cooperation in Iran. On the other hand, Iran continues to state its commitment to the Non-Proliferation Treaty via national security channels. One of the key sticking points of the negotiations will certainly be Iran's 400 kilograms of highly enriched uranium. Moving on to the trade talks and U.S. trade policy, the 90-day pause announced back in April for the reciprocal tariffs, that deadline is soon approaching on July 9th, after which those tariffs would be expected to come back online. The U.S. at the beginning of the pause stated that it would be looking to reach deals with all of those countries by then, but so far only a limited number of countries have reached a trade deal with the U.S., namely China, the UK, and most recently Vietnam. There's still some hope that deals will be able to be reached and that those reciprocal tariffs will not be implemented against its trading partners. However, following a lack of talks, it was announced today that the U.S. would impose 25% tariffs on South Korean and Japanese imports, dealing a blow to some of that optimism. Overall, we continue to see a lot of uncertainty as to the direction of U.S. trade policy and its implications for the global economy. Weather. Looking at the latest weather forecast, temperatures across Europe are expected to move above the seasonal average as we move through this week, and particularly at the beginning of next week, with temperatures being noticeably above the average, particularly in Western Europe and Northern Europe. In terms of precipitation, we're seeing less precipitation this week than we saw the previous week, with precipitation particularly across the Nordics and Western Europe being rather limited. In terms of average wind speeds, following a decrease over the past week, forecasts for this week are indicating wind speeds in line with that of last week as well. Lastly, for the weather section, the Atlantical tropical weather outlook remains relatively unchanged over the past week, with just some of the remnants of a tropical storm there moving into the U.S. East Coast in West Virginia, and South Carolina. Microeconomics. On the macroeconomic front, the latest PMI figures were released for the month of June, which continue to show a rather resilient global economy, with the composite PMIs improving slightly over the past month and remaining above the 50-point level, indicating continued growth. Taking a closer look at those PMIs between the manufacturing and services sector, particularly for the euro area, we note a slight improvement in both, with more stability in the manufacturing sector, with the PMI just under 50 points over the last month, while the service industry moved into growth territory as well, with a PMI figure of 50.5. Crude oil and LPG. Looking at global crude oil markets, we note a relatively stable price evolution over the past month, with WTI prices moving up just 1.7%, with Brent crude moving up slightly more, with a roughly 2.3% weekly increase. Global crude oil prices are seeing additional support on the demand side of things, particularly due to that optimism regarding those deals being reached between the U.S. and its trading partners, potentially leading to some additional oil consumption moving forward. On the supply side of things, a bit of a mixed bag. On the one hand, OPEC Plus announced that it would be increasing production quotas next month by almost 550,000 barrels per day, a pretty notable increase in production quotas, while at the same time, the low crude oil prices that we currently see are leading to a decrease in the rig count in the US, potentially signaling a drop in oil production from the world's largest producer. Looking at the latest EIA monthly global petroleum balance outlook, we note a slight deterioration in the supply and demand balance compared to previous months, with a slightly tighter supply and demand balance now being forecasted for the remainder of this year and next year compared to previous reports. But nonetheless, the supply and demand balance continues to be in favor of supply, owing to the stability and lower oil price levels that we currently see. Natural gas. Looking at natural gas prices next, we see a pretty stable price evolution over the past week with pretty limited movement, particularly in the remainder of 2025 and in 2026. The Q4 25 product, for example, moved up just 0.2% over the past week, with the frontier increasing minimally at just a 0.1% increase. Moving on to the fundamentals, we note storage levels across Europe moved up to just over 60% as of the end of last week, on the back of injection rates above the average since 2012. Nonetheless, injection rates have decreased slightly over the last couple of weeks, owing to the tighter supply and demand balance as a result of the higher temperatures and greater demand from the power sector. Nonetheless, injection rates remain above last year's levels, which continue to help decrease the storage deficit versus the previous year, although at a slightly lower pace than previous week. And now the storage deficit has moved down to just around 18%. In terms of the total supply and demand here, we can appreciate the tighter supply and demand balance, with total demand increasing at a faster pace than total supply. On the demand side of things, the increase in demand very much driven by the warmer weather and higher temperatures, leading to additional demand from the power sector. In terms of supply, the increase in total supply is largely owed due to the improvement in Norwegian gas flows over the past week. Taking a closer look at the European gas supply mix, there we note the slight improvement in North Sea production, increasing its share, while on the other hand, LNG sendouts has seen its share come down as demand for LNG has weakened slightly over the previous week. Here we can appreciate the increase in Norwegian gas flows over the past week, now moving up to be slightly above the average of the last 6 years and now more in line with last year's levels. At the same time, the increase in Norwegian gas flows has decreased demand for LNG sendouts, pushing overall LNG sendout down to slightly lower levels than we've seen previously, but nonetheless still at the top of the range over the last 6 years. In terms of the price competition for LNG between Asia and Europe, while we can appreciate the larger difference between the gas price in Asia and Europe, the overall price competition between both regions remains somewhat muted, particularly as the netbacks on US LNG exports continues to favor Europe ever so slightly. Lastly, for the gas section, looking at the investment fund positions, we note a slight drop in the level of long positions. And if you recall from our last week's presentation, this was to be expected as this data now reflects the ceasefire between Iran, Israel, and the US, which very much helped decrease the risks to the European gas market, reflected in the drop of prices and now in the drop of net long positions. Coal. Looking at global coal prices, we note relatively limited movements over the past week, one exception being the slight uptick in the API2 index for the forward year, with an increase of 3.2% over the past week. Globally, on the demand side of things, we're seeing slightly weaker demand from Asia, on the back of robust Chinese domestic production of coal, reducing demand for imports, and also a drop in Indian coal import demand as we move into the monsoon season. On the other hand, in terms of global supplies, we are seeing a drop in Indonesian coal production of roughly 10% over the first 5 months of 2025. Looking at Europe in particular, we note an increase in ARA stocks over the past week, increasing from the 3-year lows that we saw at the end of June. And although ARA stock levels remained low compared to previous years, when we take into account the relative demand for coal across Europe, we are in a more comfortable position owing to the limited upward pressure on the market. One factor that is certainly increasing some of the upward pressure on coal prices in Europe is the uptick in coal-fired power generation, as you can see here, increasing that from the lowest levels over the last 6 years to now slightly above last year's levels. EU and UK emission allowances. Then looking at the emission allowances here, we note the limited movement as well there, with prices in Europe moving at just around 1%, while prices in the UK came down just under 1% over the past week. For carbon allowances, certainly the optimism or the prospect of a deal regarding the US trade wars could ease some of the future demand, while at the same time the prospect of a return of those higher tariffs could eat up into industrial demand there as well. In the short term, the higher temperatures could lead to additional coal consumption, as we've seen over the past week, leading to some additional emissions from the power sector, which, as we can see here, increased noticeably over the last couple of weeks, moving up from the lowest levels since over the last 6 years to now higher than the past couple of years. In terms of the investment fund positions, we've seen a decrease in the level of net long positions over the last couple of weeks, in part owing to the decrease in the price level we've seen over the same period of time. Over in the UK side of things, net long positions remain dominant in the market, largely due to the ongoing prospects of linkage between the EU and UK markets. Electricity. Looking at electricity prices, focusing first on the German power market, and here we see a similar price evolution as with natural gas, with relatively small movements over the past week. Prices for the last quarter of 2025 moved up by just 0.3%, with the front year moving up by around 0.5% over the past week. In the short term, certainly the warmer temperatures and higher the power demand will certainly add some additional upside pressure on the market, but nonetheless, the stable gas price evolution, as well as the stable price evolution for carbon allowances, leading to that stability in power prices as well. We see that similar price evolution across other European countries for the front year, as you can see on the left here, while looking at the Nordic market in particular, here we see some additional downward pressure owing to the improved hydropower outlook in the region. In terms of total demand and residual load there, we see that increase over the last couple of weeks, largely due to those higher temperatures increasing cooling demand, with total grid demand now in line with the average over the last 6 years and last year's levels. In terms of the supply mix there, we see that the strong performance in solar power generation has helped ease the share of fossil fuel power generation in particular. Moving on to nuclear power generation, we see an uptick in the French nuclear power output, now moving just above last year's levels and increasing the gap between the 6-year average. So far, the corrosion issues that we discussed starting a couple of weeks ago have not spread to other reactors, although that risk continues to loom over the power sector. In terms of renewable power generation, we've seen a slight decrease over the past week, largely due to the drop in wind power output over the last few days. And on the fossil fuel side of things, we see how the uptick in total demand has meant a greater demand for fossil fuel power generation, largely filled by gas-fired power generation, as we'll see later on. Starting with a closer look on the renewable energy generation power mix, we see that decrease in wind power generation there, while looking at solar power generation, we continue to see record high levels of output so far this year. On the fossil fuel side of things, we note how that uptick in total demand and the drop in particularly wind power output has then led to an increase in the demand for fossil gas power generation, increasing it from relatively the lower end of the range over the last 6 years, now pushing it up to near the 6-year average. In terms of coal power generation there, as we saw earlier, a slight uptick, much more modest than for natural gas, but nonetheless an uptick in coal-fired power output. Looking at hydro storage reservoir levels here, we can appreciate one of the factors that's leading to some additional bearishness in the Nordic market, with storage levels in both Sweden and Norway above the average since 2015. The same can be said for countries in the Iberian Peninsula and Western Europe, although as we look to other countries in Southern Europe and particularly in Eastern Europe and the Balkans, we see a less optimistic picture at the moment. Lastly, looking at the guarantees of origin, we see an uptick in the price evolution over the past week, with that increase most noticeably felt for the 2026 and 27 production years. The uptick in the market appears to be driven by one, slightly lower renewable power generation, down 9% year over year in the first half of 2025 in the AIB area, excluding Germany, as well as additional demand for guarantees of origin, particularly in the forward years, adding upward pressure to the market. That covers this week's market presentation. Thank you for joining.